A retired couple owes the IRS $220,000. Their only resource, a $2,400 Social Security check. 16 months later, the debt is resolved for exactly $23,000. $197,000 of tax liability is legally erased. This massive reduction is a statutory requirement, triggered when a practitioner proves the liability exceeds the government's legal ability to collect it. The IRS's ability to settle tax debt is dictated by a cold, rigid mathematical formula. Practitioners who master this formula can force the agency to the negotiating table. The authority for compromising federal tax debt comes directly from Internal Revenue Code Section 7122. This statute allows the IRS to accept less than the full amount owed. Under this code, there are 3 legal pathways for an offer in compromise: doubt as to liability, doubt as to collectability, and effective tax administration. By a massive margin, the primary and most effective pathway is doubt as to collectability. To utilize this pathway, you have to understand the IRS timeline. By law, the agency generally has exactly 10 years to collect a tax debt before the collection statute expiration date, or CSET, hits, and the debt legally expires. Because of this ticking clock, the IRS relies on a single internal metric, reasonable collection potential, or RCP. This is their calculation of the absolute maximum amount they can realistically extract from a taxpayer before that 10-year window closes. If you mathematically prove an offer meets the RCP, the IRS is forced to seriously consider the settlement. This is the master equation that dictates the absolute floor of an offer in compromise. RCP equals the net realizable value of assets plus future income capacity. We start by isolating the first variable, net realizable value. NRV represents the equity the IRS could theoretically seize today. It is calculated by taking the quick sale value of an asset and subtracting any secured debt held against it. The IRS applies strict quick sale multipliers to determine this value. Real estate and vehicles are discounted to 80% of their fair market value. Cash accounts are assessed at 100%. Take the retired couple. Their home's fair market value was $280,000. An 80% multiplier drops the quick sale value to $224,000. Subtracting their $218,000 mortgage leaves an NRV of exactly $6,000. If this calculation results in zero or negative equity, the IRS attributes zero collection value to that asset. This mathematically shields underwater property from the RCP equation. With asset equity calculated, we shift to the second half of the master equation, future income capacity. This variable breaks down into 3 distinct subcomponents: gross monthly income minus allowable expenses multiplied by a payment timeframe. The IRS strictly follows their own published collection financial standards rather than a taxpayer's actual monthly spending. These include national standards for food and personal care and local standards for housing and transportation. If a taxpayer's actual expenses exceed these predetermined caps, the excess is ignored without extensive written justification. A single mother owes $64,000. Her gross income is $2,333. By documenting allowable expenses matching IRS standards, her recognized costs tally to $290, driving net income to $43 a month. Precisely mapping and justifying expenses against IRS standards rather than pleading financial hardship is the only mechanism to legally minimize future income capacity. The payment multiplier is determined by how fast the taxpayer promises to pay. A lump sum cash offer paid within 5 months triggers a 12-month multiplier. A periodic payment offer paid in 6 to 24 installments triggers a 24-month multiplier. Take the case of an overextended contractor. His finalized net monthly income is $415. Executing the math for a lump sum offer, we multiply his $415 of income by 12 and add it to his asset NRV of $7,500. This establishes his absolute minimum offer amount. Choosing between a lump sum and periodic structure drastically alters the mathematical floor, making strategic payment structuring vital for cash-strapped clients. Calculating the perfect RCP is useless if the procedural submission fails. The mandatory bureaucratic architecture requires 2 documents: Form 656 sets the terms of the offer, while Form 433A or 433B provides the sworn financial disclosure. Submitting these forms requires a $205 non-refundable application fee, plus an initial down payment based on the chosen payment structure. A vital exemption exists. The low-income certification waives all fees and initial payments for taxpayers at or below 250% of the federal poverty level. Upon submission, CSED tolling begins. The 10-year collection clock pauses. Under Internal Revenue Code Section 7122, subsection F, the IRS has exactly 24 months to evaluate the application. If they fail to decide within that window, the offer is legally accepted by default. Navigating this procedural gauntlet buys the taxpayer's safety from active collection. However, missing a single form or payment immediately invalidates the entire mathematical strategy. Receiving an IRS acceptance letter triggers a strictly monitored probationary period. Every accepted offer carries a 5-year post-acceptance compliance rule. The conditions are rigid. For 60 months, the taxpayer must file every single tax return and pay every future tax liability exactly on time. A single failure triggers an immediate default. The offering compromise is voided, and the original massive tax liability, minus any payments made, is immediately reinstated. An offer and compromise demands historical mathematical precision and ongoing absolute behavioral compliance. Doubt as to collectability functions as a rigorous financial stress test of a taxpayer's balance sheet. Professional success in tax resolution requires aggressively applying quick sale discounts to client assets and perfectly mapping actual expenditures to IRS allowable standards. Understanding and executing the math behind reasonable collection potential is the only reliable way to legally erase unpayable tax debt.